Hi guys. Today we will analyze IBM common stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. IBM has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative. The long-term trend is neutral. Strong support levels are around $118 and $115. Strong resistance levels are around $137 and $142. In the last month the stock has been trading between $118 and $138 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 6 million. This is a good sign as it is always nice to have a liquid stock. The stock is currently trading in the lower part of its 52-week range, which is not a good signal. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around -6% per year, for last 5 years. We see that the average profit margin of the stock has been around 9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 234% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for IBM company: bad, average, and good. First scenario. IBM will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 0%. Future profit margin would be low, 7%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $80. Second scenario. IBM will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1.5%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 100%. In this case, the fair value of the stock today would be $119. Third scenario. IBM will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 9%. Future free cash flow to net income rate would be high, 120%. In this case, the fair value of the stock today would be $169. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.35. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For IBM, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 14. Again, I will use 3 different scenarios for IBM company: bad, average, and good. First scenario. IBM will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $32. Second scenario. IBM will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future P/E would be average, 18. In this case, The fair value of the stock today would be $49. Third scenario. IBM will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 22. In this case, the fair value of the stock today would be $66. As you can see, today the stock is overvalued, $125, even if we expect the company's high performance in future. The fundamentals are not good. IBM has one of the worst debt-to-equity ratios in its industry. Over the next 5 years the revenue will grow only by 4% on average per year. And the stock is currently a little bit overpriced. I may consider buying the stock for the dividend, 5.21% yearly, if the stock drops below $100. Company's strengths. IBM is a leading US-based provider of enterprise IT hardware, software and services. Hybrid cloud and artificial intelligence are the major growth drivers. IBM also sees opportunities in areas including cybersecurity, blockchain, and quantum computing. About 2/3 of recurring revenue is now derived from software, versus 45% prior to the spinoff. Additionally, IBM now derives about 70% of its revenue from higher growth areas, versus 55% prior to the spinoff. The company's revenue growth is no longer being impacted by the slow-growth low-margin GTS business, most of which was spun off as Kyndryl. The main difference at the new IBM is in margins. Adjusted pre-tax margins are rising significantly. The gross margin is also improving. Another vital growth driver is the series of evolving partnerships with major cloud providers, AWS, Salesforce, SAP and Azure. IBM has a return on assets of 6%. This is better than the industry average of 0.6%. IBM has a profit margin of 8%. This is better than the industry average of 2%. IBM has a return on equity of 42%. This is amongst the best returns in the industry. Risks. IBM's risks include competition in its hardware, software, and services businesses, as well as legal issues and the possibility of further declines in IT spending. IBM has one of the worst debt-to-equity ratios in its industry. 90% of its industry peers require less debt for financing their operations. IBM is not financially healthy enough and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, IBM will show a small growth in revenue. The revenue will grow only by 4% on average per year. The earnings per share is expected to grow only by 4% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.